Hey everyone, today social media is playing a huge role in influencing our decisions. For instance, if a friend travels somewhere or buys a new car, we immediately feel that FOMO. And let's be honest, the stock market is no different. Today, a lot of investment decisions also get influenced by social media. In fact, today, social media amplifies our emotions of fear and greed multifold times. For instance, if a company looks promising and it posts good quarter results, everyone starts discussing it over social media platform. Be it YouTube, Twitter, Instagram, WhatsApp, Telegram, and retail investors start feeling FOMO. But the catch is, by the time everyone is aware, the stock is already trading in a different orbit altogether. So when retail investors feel FOMO, they end up buying the stock at any valuation. But the truth is simple. Every business goes through cycles. No company delivers great numbers every single quarter. So the moment performance dips, sentiment changes. And when weak results meet very high valuation, the correction is very sharp. And many retail investors end up losing money. On the contrary, when a company enters rough patch, maybe margin dip, let's say demand slowdown or a competitor making noise, then the crowd instantly shifts to negativity. Meme starts, narrative spread, and suddenly no one wants to own the stock. As a result, the stock price starts falling. Not because the business is broken, but because sentiment is broken. Now, if the correction is due to a temporary problem, fall in stock price make the valuations attractive, and that can be a great opportunity for investment. This is the foundation of Contra Investing. Going against the wind, looking where nobody is looking, and buying when the crowd has given up. Now, in the previous video, we discussed this concept of Contra Investing with 5 case studies on how companies that were once hated over social media eventually outperform. If you haven't watched that video, do watch it first. On further digging, I realized that today there are so many such examples where businesses are facing headwind that have resulted in sharp correction in stock price. But the most interesting part is only the weak hands of retail investors are selling their stake. Yes, the total number of retail shareholders in those companies are reducing and big institutions are accumulating the shares at lower levels. That's where I've decided to start a new series where we will discuss businesses that are fundamentally strong but are going through temporary headwind and sentiments are very weak. As a result, retail holding in those companies is reducing, but smart money is quietly accumulating the shares. Because if the company is strong and valuations are corrected, the risk reward becomes better. And when the cycle turns, these companies can recover very well. But the big question is, how do you identify if a company is fundamentally strong and going through a temporary pain, not permanent damage? That's where I've created a step-by-step framework for Contra Investing. In this Contra Investing series, we will assess companies across this framework to figure out whether the correction is an opportunity or not. But in this video, I would explain this framework so that you can understand my thought process. Okay, let's have a look. So the first step of Contra Investing is to check if the business is fundamentally strong or not. See, Contra Investing only works when the underlying business is strong. Because if you don't understand the business, you will never understand whether the correction is temporary or permanent. Now, how do you know if the business is fundamentally strong or not? So there are 3 sub-steps. First is understand the business model. How does the company actually make money? Is the business cyclical or structural? What is the moat or competitive advantage of the business? Then second sub-step is to look at the management quality. In a falling stock, management quality decide whether the company will bounce back or break down. Good management turns a correction into an opportunity. Now, how do you check management quality? So first of all, look at their track record. How is their execution in the past? Were they able to deliver on their promise? Then second important way to gauge management quality is how do they communicate during difficult times? Are they conducting the con call transparently? Are they explaining the issues clearly? Or do they blame market condition for every bad quarter? Or do they accept that there is a problem? Because if you do not even accept the problem, you can't solve it. A good management would always communicate honestly during both good times and bad times. Then another way is to look at promoter holding. Do they have a meaningful holding or not? If the management keep reducing the stake, then you need to be careful. Although here the catch is, in many cases, companies do not have individual promoters. Many new age companies have professional management team where promoters are either PE or VC firm. In that case, they can reduce stake. But the key is who is buying the stake from them. As long as stocks are bought by a reputed institution, it's not a problem. You can also look at the promoter pledging. Ideally, I avoid companies where there's a high promoter pledging. Then third step is look at the balance sheet strength. When you're doing contra investing, the balance sheet is your seat belt, because when a business hits a slowdown, only companies with financial strength would survive that difficult phase. A weak balance sheet can turn a temporary problem into a permanent collapse. So always avoid companies with high debt, because debt can be a big culprit when the business is going through tough time. A low debt or debt-free company has high probability to survive the difficult phase. Then you can look at cash flow. When cash flow stays healthy despite weak demand, it tells you the core business is still solid. Then third, you should look at the working capital structure. If the receivables are too high or increasing, inventories piling up, cash conversion cycles are too long, these are red flags. So the bottom line of first step is, if a company has sound business, clean management and strong balance sheet, company will survive and bounce back. If any of these three pillars are weak, company does not qualify as contra bet. Now in the second step, you need to identify whether the problem is temporary or permanent. This is where most investors go wrong. A falling stock, let's say if a stock has fallen 40-50%, it looks very exciting. But the question is, why did it fall? The reason determines whether it's an opportunity or a trap. So there are certain temporary issues that are good for contra call. These are short term in nature and they're often cyclical. For example, it could be, let's say, inventory destocking, or raw material inflation, or let's say temporary demand slowdown, or let's say short-term margin pressure, or geopolitical issue, or one-off expenses, or it could be, let's say, policy uncertainty or industry correction. If the issue is temporary, valuation cools down, but the long-term story stays intact. This qualifies as potential contra opportunity. But if the problem is permanent, avoid it at any cost. Some of the examples of permanent issues include losing a major customer permanently, or rising competition with no strategic response, or business model becoming obsolete, or corporate governance issue, or several promoter pledging, or let's say consistent negative cash flow or excessive debt, or sector disruption, or let's say margin collapse that cannot be recovered. These are not contrarian opportunities, these are value traps. So the bottom line of step 2 is, if the pain is temporary, it's a contra opportunity. If the pain is permanent, run away. Now in the third step of contra investing, you need to check if the long-term demand story is intact or not. Even if the business is temporarily struggling, you must check whether the industry has future growth or not. Contra investing only works when the long-term demand trend is positive. So you need to check, can the sector grow at 10-15% CAGR rate over the next decade? Is the company on the right side of disruption or not? Are customers expanding? Are industry tailwind predictable? Then the fourth step of contra investing is, valuation must have reset. This is the most critical and the most ignored part. A falling stock 40%, let's say, does not make it cheap. You have to check if the valuation has truly corrected or if it is just correction from absurd level. Now, how do you know valuation has reset? So first option is, you compare the current valuation to its own historical average. Like you compare current PE with 5-year median PE, or current EV to EBITDA to 5-year median EV to EBITDA, or current price to sale to 5-year median price to sale. If the valuations are below the historical median, it suggests the valuations have cooled down. Of course, there are certain exceptions. Then you can compare with the sector valuation. If the entire sector is derating, your stock will derate too. For example, today the entire IT sector is derated. Here you need to wait for sector-wise stabilization before entering. Here I would tell you one of the easy hack to know whether the company is fundamentally strong and valuations are good or not. So you can check the shareholding pattern. If the company is fundamentally strong, you will find reputed institutions holding stake in the company, including FIs and DIs. In case company is micro cap, and if it does not have FI or DI, because usually some companies, institutions, they do not invest in very small companies. In that case, it should have HNI investor. So if company does not have, let's say, FI, DI or HNI, then there are high chance that the company is not fundamentally strong. Second, when the correction is due to negative sentiment and not due to weak fundamental and valuations have become reasonable, you'd find that institutional investors like FIs, DIs or HNI investors would increase stake in the company and public holding would reduce. Once you identify a strong contrarian setup fundamentally, you can also use basic technicals just to time your entry better. I usually prefer the stock to come above 50-day moving average and 200-day moving average. If 50-day moving average crosses 200-day moving average with good volume, that is even better. Just avoid catching the falling knife and ensure that selling pressure has reduced. So overall, if we conclude, if you want to identify a true contrarian bet, business must be fundamentally strong. That includes strong business model, strong management, healthy balance sheet. Then the problem must be temporary, not structural. Third, the long-term demand must be intact. Sector should have a bright future. And finally, valuation must have reset. If a company ticks all these 4 boxes, it qualifies as a genuine contrarian opportunity. So in the coming video of this series, we will discuss many businesses around this framework to identify if the business is fundamentally strong or weak. And then we'll look at the reason for correction. And we'll also look at the potential recovery trigger. But before we start with the series, I want to clarify a few very important points. So first of all, contra investing is not easy. It requires a lot of patience. Many companies may remain out of favor for a few quarters or sometimes even a few years. And most retail investors don't have that kind of patience. Second very important point is, contra investing does not mean buying every stock that is falling. A lot of investors catch the falling knife. They buy companies with weak balance sheet, poor governance or broken business model. And then they keep averaging it down. That is not contra investing. That is disaster. In the previous video, we discussed how companies like Yes Bank, Gensol Engineering, BCG, Reliance Capital, they kept on falling due to weak fundamentals, but number of retail investors, they kept on increasing. For a stock to qualify as a contra opportunity, the fundamentals have to be strong. The balance sheet should be clean, management should be reliable, long-term demand story should remain intact. Only the sentiment should be negative, not the business. And one last point, keep limited exposure in contra bets. Maybe let's say 20-25% of your portfolio. Because if your portfolio is tilted more towards contra bet, some of them can test your patience for too long and drag your portfolio performance. With this, let's close this intro video on new contra investing series. In the coming video, we'll cover many exciting companies that have gone through a long period of correction and consolidation. Now you tell me in the comment, which company do you think are a solid contra bet at the moment? I'll go through some of the comments and maybe I'll pick some of them in our videos. I'll see you next video. Till then, take care.